You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. Welcome to the show, Danielle.
Hey, Jim.
Oil everywhere. Russia, even though they're getting very little for the oil, has never pumped out more oil in its entire existence. What is going to happen to oil prices with all this oil sloshing around the planet?
Well, that's what everyone's trying to figure out, Jim, but it's just kind of like with every other commodity in the world. When you have too much of it, more than people can use, you store it. That's the first thing you do. You try and stockpile it in the hopes that demand will come back and people will want what you have in storage. But once your storage facilities become full, as I was writing today, Cushing, Oklahoma, which is where the WTI storage in America all goes, is coming up to 90% full as we speak, and it's estimated that it will be full in March. A similar thing is happening in the Brent crude storage facilities in Europe. Tankers are all floating all over the ocean full. There's only so many places you can put this stuff, and we're sort of riding around in the market price these days on every rumor that OPEC is going to come up with some kind of a concerted agreement to cut production. The problem is that if you do the math, even if they were to cut 5% of their production, it wouldn't do really diddly squat, so to speak, and use a technical term there, Jim. It wouldn't do anything for the fact that we already have this massive supply on the market. So it's a multifaceted impact. It is also from the plunge in demand because the world economy is slowing, and it is on top of that the excess supply issue. So it's really both things coming out at the same time. Eventually, there's no doubt, that if prices stay low long enough, you're going to see some participants beginning to default on their debt and go out of business, be taken out by stronger players. You're going to see some wells closing down. But all the innovation, all the the new drilling techniques that have happened in the last number of years just make it so much easier to pump stuff out that it's just all those factors together. So where will oil go? Very hard to say, but we know that desperate for cash flow producers need to pump as long as they can keep the power on, so to speak, in order to get cash flow. We know that sunk costs in many places in the Crimea Basin and places like that, they could pump oil between $10 and $20 a barrel and still justify keeping the doors open, so to speak, because the costs have already been, sunk into the projects. So it doesn't look to me like there's any reason for prices to have a sustained uptrend in the foreseeable future, certainly not in 2016. Now, if you've got some kind of a big foreign conflict, potentially you could see a spike in the price. Whenever the U.S. dollar weakens, you tend to see a spike in the price. And there was a revelation, I think, this week that the U.S. Central Bank probably won't be hiking rates as it had previously said it was planning to do in 2016. That the economic data just keeps coming in so weak, and they've recognized it was probably a policy mistake to try and hike rates at their last two meetings ago. So all this has sort of led to U.S. dollar weakness this week, which has given this sort of jump to oil. But I think these are all trades. These are all algorithm traders, people trying to game something. But as far as an investment goes, as far as a sustainable demand picture goes, it's still extraordinarily bearish, I would say, for many of the world's commodities, not just oil.
Well, Alberta's biggest need is a pipeline to Tidewater somewhere. In BC, there's so much resistance because they know the damage an oil spill would do here. And then we have the mayors in the Montreal area saying they don't want no stinking pipeline either. Does the rest of Canada not care, or do they realize how much money comes out of the Alberta oil patch, whether you like oil or not?
Yeah, no, most people don't know anything about the math of how our revenues are generated and, where our tax dollars come from and how they're allocated. Very few people follow any of that. The problem is that humans tend to only recognize things when they're forced to and in moments of crisis. They're very bad at preparing or foreseeing coming trends. And so, of course, we didn't prepare for this day in advance. Most the governments certainly didn't. Now what I'm seeing is a lot of the provinces are floating long-term debt. Newfoundland, Labrador was issuing some 2043 paper, I believe, this week. I've seen Alberta come to market issuing debt. We're seeing the Saudi Arabian government, who has a AAA credit rating, coming to talk to bankers about how they can float paper. And all that really tells you is that these people who can borrow, companies that can borrow, have continued to borrow through this period in order to try and keep going and be one of the last ones standing. Provinces and different jurisdictions, as I say, like Saudi Arabia, are doing the same thing. But the problem comes in with the weaker people who already have bad credit ratings. So the corporations that can't borrow more, or if they can borrow more, they have to do so at exorbitant rates. And I mean, high yield debt rates have jumped 18% in many cases. Countries like Russia's already, just a double B credit rating, or countries like Venezuela, they're a C credit, their junk bond status. These are the really weak players who can't borrow money. They can't borrow money because they already have too much. Their credit rating is too low, and the rates have now spiked that much higher. So this is kind of a standoff to see who folds first. And I think that in this first quarter of 2016, we're going to see an acceleration in the people who are folding, not because they're choosing to, but because they literally run out of cash and can't borrow more. And that's going to, in the near term, ironically, instead of creating a deficit of production, I think that's going to create a dumping of production. So in other words, as they are going down in fits of the death spiral, what they do is they flood whatever they have onto the marketplace, or someone else buys up their product. So again, it doesn't sop it up, so to speak. It just sort of throws more onto an overly supplied market.
Danielle, too, what's happening now is more and more people are looking at alternative forms of energy for transport. And you point out now they're even making highways and bikeways that generate electricity from solar panels. And the facility's right there. You just have to lay this special polymer over the top and you're making power.
Yeah, in terms of technology and innovation, there's a real growth spurt on in the world today, and it's all over the place, and it's very encouraging indeed. People are getting a lot more intelligent with how we're using energy, how we're conserving energy, and harnessing the passive energy sources that are available. Again, none of this is particularly bullish for oil, because even though the world still uses a ton of oil, this is a demand destruction story that is taking place, slowly and then all at once. So, yeah, I think that, even as oil prices have come off, the impetus to be smarter and more efficient and, as I say, harness passive sources has not died. And I think that surprised some people, but I think it's because humanity has just come to the point where we realize we have to utilize, first of all, because our computing power has got so huge, in the last, 10, 20 years, that now things that we thought were, improbable or impossible have become completely possible, and you're getting a lot of people just in leaps and bounds going forward with that. So there's huge progress on that front. The part that is a missing piece, and there was an excellent documentary called Cowspiracy that I put on the blog this week, a documentary that points out that although we're making all these leaps and bounds on the energy front, what we're really not addressing is the way in which we're producing and consuming food in the world. And all the climatic impact that's happening is primarily coming from the clear cutting of forests and the mass production of animal agriculture. That's where a huge amount of our water's going. That's where the massive amount of our resources are going, for growing crops, for example, to feed to large beasts like cattle. And that's really the elephant in the room, so to speak, because as I say, we've made all this, great progress on reduction of consumption of energy in terms of alternatives, but we're really not addressing the bulk of the issue, which comes down to why are we feeding so much of our global resources to animals in order to eat them, when a obviously more efficient methodology would be for humans to consume plants as our primary fuel. So when you talk about energy, I think of food as energy to, in the way that we use food in the world. And it's just, there's a lot of work to be done in that area. So enlightenment is a very slow process, and most of the environmental websites that are championing all these wonderful technologies and energy and renewables are not noticing or commenting whatsoever on this whole, animal agriculture piece. So I think we've got a lot of work to do still.
Well, I have a relative in London who has developed a system where she has fish and vegetables growing in cargo containers. So the fish fertilize the vegetables. The vegetables are basically hydroponic apart from the byproduct from the fish. The fish live in the water growing the plants, and they're putting them behind supermarkets and restaurants. So they have fresh fish and fresh veggies all year round, and it's self-contained. It doesn't pollute. And you don't have to pay transportation costs, just a little electricity to keep the pumps going.
Yeah, that's the type of solution. That's exactly the type of solution that we need to focus on. A lot of urban farming is coming out. A lot of these container shipments, as we've discussed before, are providing these kind of urban, immediately local solutions that are incredibly less fossil fuel intensive, no question about that, because you're not having to ship, and it's fresh, and it's being done right at sort of outside the door of restaurants and supermarkets. All that is extraordinarily smart. The lion's share of the issue, though, is not. So that's a great individual solution for a community or for families or for restaurants. The bulk of the problem still goes back to how much of our land is being used and how much of our water is being used and our energy is being used to grow crops which are not fed to humans but which are fed to animals. And that is just an extraordinarily inefficient trade-off when you look at that. But the problem is behavior-wise, everyone is sort of very entrenched in, our milks and cheese and, butters and all these things that we come to, we've made a whole food industry around. And when you had 1 billion people in North America, that was one thing. When you've got, when you had 1 billion people in the world, that was one thing. When you've got 7 billion, it's quite another. And so I think you're exactly right. Those solutions are part of this process. The trick is going to be, how do we placate people's diet or, let's say, yearn for example, cattle-based products, and what can we do? Because fish and chickens are kind of smaller, right? They take less resource, and you can imagine solutions easier for that. But it's the large animal stuff that is more of a challenge. But having said all that, there's a lot of science that is also being applied. Silicon Valley is doing a bunch of venture stuff, trying to replicate many of those, beef-type experience with proteins as well as with, the milks and cheeses of the world. So I'm entirely encouraged that it's possible, but unless we have discussions and admit the facts about what is causing the bulk of our inefficiencies in our system and our why our resources are exhausted, unless we actually have those actual conversations, people tend to not be aware.
What about the currencies around the world? It seems everybody's racing to the bottom. The yen wants to devalue again, the yuan. The U.S. dollar's been climbing, but it's hit a little bit of a break. And, of course, in Canada, we're paying sky-high vegetable prices because of our low dollar. But when will that insanity end, or will it end up to a case where we have currency that's worth nothing?
No, I don't think we'll have a currency that's worth nothing, but our currency was very overvalued with the oil and commodities bubble into 2011. And so this mean reversion is just a recognition of that bubble unwinding, which we've seen, as I say, with the commodity prices. And our currency really had to move from very overvalued to, getting towards fair value now. So this is actually competitive devaluation, and amongst currencies is a great deal of the solution. This having prices come back down and having countries, make their products more competitive to others because their currency has devalued is one of the most successful ways to reinvigorate and realign the global economy. So that's all very positive. The question right now is, because everyone's in this, quest to find exports and to sell products elsewhere, you have every time, the Chinese yuan was pegged to the U.S. dollar for a long time. They've been loosening that peg. Why? Because the U.S. dollar has been in such a huge upcycle since 2011, and so their goods have become more expensive, and they don't want that. But every time that they try to slacken off the peg and weaken their currency, then you have a race to the bottom in Asian countries who are all competing for the same export market. So I think this is all natural. It's kind of like pistons in the system letting off steam or something to try and get things back in line. And I think the more central banks and governments try and intervene, the more messed up it gets. They should really allow free market forces to try and find its own level when it comes to the currencies of the world. Right now, as I say, the U.S. dollar has been on this huge uptrend, and that has been the inverse of that has been the weakness in other currencies as well as the commodity markets. The question for everyone is, are we at the end of that upcycle now? And no cycle lasts forever, so certainly we're always looking for signs that we may have hit the peak in that expansion period. I think there's an argument to be made that it isn't here yet, just because I still see that there's a lot of overvaluation in other assets in the world. The S&P 500 is an example, still historically very highly overvalued at this point. You also have investor sentiment in general is not super bearish yet, so you haven't had, I don't think, the bulk of the selling that we're likely to see in the overall equity market, certainly in North America. And until you get that kind of capitulation, I think when we get that kind of capitulation, we will get the same type of dynamic that we did in the last couple of massive bear markets, where everyone stampedes out of risk assets and goes to the deepest, most liquid assets in the world, which is U.S. Treasuries, U.S. dollars. The Japanese yen has also been a traditional recipient of those flows. But when that happens, I think you may still see another leg of strength in the U.S. dollar. But we're watching it very carefully because, as I say, once every other currency has fallen dramatically, you have to be looking for the turn. When will this trend revert? And at this point, we could be getting close to the end of that expansion. But as I say, I think until we get panic and selling and a final capitulation washout in some of the bullish sectors, I think you may still see some more strength in the U.S. dollar.
It's reported that Canadian individuals are sitting on a record $75 billion in cash. Where should they put that money, and were they smart to take their stocks out and keep it in cash?
Yeah, well, I think having cash is an intelligent thing to do. Some people have been buying safes and putting some in their house, and that is a sort of a worst case if the machines were down, if the debit machines weren't working. We have to acknowledge that is a potential outcome, because weren't we assured in 2008 that they had to pump in money into the system, or the ATMs were going to stop working. So it could be that you would have a shock to the system, and people will want to have some cash in a safe in their house, so that's fine. But you can't have the bulk of your savings in a safe in your house, or at least from a risk management perspective, I wouldn't recommend it, right? So then the question becomes, what do you put it into? Well, if you listen to the long always side, which is the bulk of the financial industry needing people to be buying risk products in order for them to generate their fees, they never want anyone to hold cash, right? So they always want people to be perpetually buying stuff. And if you listen to the talking heads on CNBC, the Lloyd Blankfein from Goldman Sachs was on, and you had Bill Miller, long always money manager who imploded in 2008, lost something like 60% of his money, of the client's money, and then he's wrote it back up, and then he's still talking about being, long always and always buying and all that. But if you listen to anybody that's not paid to keep people's sort of feet to the fire, they're saying, why wouldn't you take some capital out of risk assets and park it on the sidelines, keep it in cash where you can utilize that as a buying fund when prices finally, correct and are sort of looking like good value again. So I always try and tell people, just because it makes sense to make an RSP contribution from a tax perspective doesn't mean that you have to buy stocks or mutual funds with it when you put that money in the account. Just because you have money in savings inside an investment account doesn't mean that you have to buy stuff with it all the time. You can actually keep it in cash and cash-like equivalents and still maintain your purchasing power going forward. And no one's talking about putting it there for the rest of your life, but we're saying that we're in an extraordinary period. This is an extraordinary period in market history. This one will be in the history books for a long time. We will be talking about the derangement of central bankers and the initiatives they took during this period, I think, for the rest of our lives. So, individuals can't afford to suffer through their third 50% loss cycle. This would be the third one since 2000, right? Especially as they're getting older. They have to be more proactive in terms of managing their own risk and not just drinking the Kool-Aid handed out by the, happy-go-lucky bartenders from the finance business. So it's just it's sort of a do save, do make contributions to your RSPs, but just don't always think you have to buy risk with it.
What about these new electronic banks like EQ offering 3% on a special savings account? Is that realistic, and is it sustainable?
Well, I haven't seen that particular offer. I do know that banks in general are looking to raise deposits right now. Some of that is capital ratios are tightening up, and they have to raise capital. So I have noticed some incentives for, if you bring your money from one high interest savings account at a different institution, they'll give you a 0.3% hike for the next 6 months kind of thing. So they are doing these sort of things to entice capital flows into different institutions. To some extent, that's normal retail stuff. They've always done that. But, I think remember back in the crisis in 2008, many of the paper that was sold to people as, guaranteed or cash-like but higher yielding turned out to be not guaranteed and not cash-like but full of risk. Do you recall that paper getting all frozen?
Oh, yeah.
And many of the institutions that were selling it got into problems, and there was lawsuits and all that. So I wouldn't be enticed for, an extra short-term yield if it means putting your capital in harm's way. So there are some high-interest savings accounts that you can earn up to 1.5%. Maybe there's some special products that make sense, but in general, I'm leery of things that offer you your cake and eat it too. If they promise you it's cash, that should mean that you don't have to sell something in order to get your cash. Whenever you're in a product that has to be sold on the market in order to give you your cash back, that's not actually cash.
Danielle, thanks a lot for chatting with us.
Thank you, Jim.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite. Her website is jugglingdynamite.com. You're listening to HowStreet.com Radio. Find us on Twitter at Talk Digital Net. Our popular YouTube channel is Talk Digital Network. Questions or comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of How Street Media Incorporated.